that silver gets to $70 in the next week. And it's Friday and it's almost the close of the market and somebody bids 75. But it's for one lot, it's for one contract, and it gets accepted. Everyone that owns silver would look at that and say, my goodness, silver's at 75. North America is by far the largest purchasers of retail silver products. A new situation where the Eastern exchanges actually start to be more of a dominant force in the overall physical delivery mechanism than what we've seen in the past. Well, gold has been the leader. Gold could not shoot up alone without, and be in a true new bull market without confirmation from silver and really from platinum palladium. But silver has a propensity to spike low and spike high.
If you're looking for silver to go to 100 within the next couple months, that means that the bull market might kind of be over.
We're in a pretty frothy market right now. I mean, we've seen silver pretty much double this year, and we haven't had that kind of move in silver since the 1979 going into 1980 time frame. So that's one thing. Anyone that follows the metals markets is aware of that. I think the other part is have we gotten ahead of ourselves temporarily? Now, on an inflation-adjusted basis, the new 60 does not equal 50 of 1980 or 48.5 of 2011, but nonetheless, we are in nominal new highs. And I think we need a little bit of, let's say, of a pause, perhaps, kind of rebuild a base before this. I don't think it's a runaway market, but it's actually very, very strong.
Certainly. I mean, that's one of the things that Lobo Tigre was talking about with me yesterday, about how be careful what you wish for. If you're looking for silver to go to 100 within the next couple months, that means that the bull market might kind of be over because we'd see that blow off top. Your take on that, do you anticipate that we're going to build that base as you talk about and then move higher, or are you anticipating that it's possible we could just kind of have a blow off top at this phase?
Silver's meteoric rise this year is setting up an understated risk for short-term investors. The metal has nearly doubled, a magnitude unseen since the 1979 to 1980 surge. But inflation-adjusted comparisons show we aren't hitting historical peaks yet. Analysts like David Morgan caution that chasing $100 too quickly risks a blow-off top, exposing momentum buyers to rapid corrections. For context, the 2011 peak saw similar acceleration followed by a 30 to 40% retreat. Watch how base building could determine whether gains hold. Next, David Morgan talks why this pause could define the sustainability of the silver rally.
I will answer your question, Elijah, but several years ago, I was asked by Futures Magazine to write an article on silver. And it was a bit of an honor, really, because most of them have to be CMTs or whatever, certified market technicians. I'm not very well versed in technical analysis, but the title of the article Spiked, and then the subtitle is something about silver. But silver has a propensity to spike low and spike high. And of course, anyone that looks at that cup and handle that's been referred to ad nauseum in the silver community, which is true, it's a huge cup and handle, and it is the most powerful formation. But the point is that if you look at it, you see these big spikes, spike in 1980, spike in 2011, and now we are spiking again. And in the article, I pointed out that when you get a parabolic move like that, it goes more or less straight up, often referred to as the hockey stick. To reiterate what you just said, be careful what you wish for, because it is telling us, and it doesn't matter if it's silver, soybeans, soybean oil, whatever it is, a stock, it is going to correct very rapidly as well. And the end is nigh. Nothing can grow straight up and then not come down at some point.
Those spikes in silver often mask the instability beneath the surface. Historical peaks in 1980 and 2011 illustrate parabolic hockey stick moves, which David Morgan has flagged as inherently fragile. Even futures markets echo this, with rapid corrections often wiping out short-term gains. When markets go vertical without breadth, small retail investors risk panic selling. This isn't speculation. Parabolic structures historically precede swift pullbacks in metals and commodities alike. Up next, David Morgan analyzes how these spikes interact with base-building strategies to stabilize long-term gains.
I think, to answer the question, that we will back off. We're backing off today as we're doing the interview. And I think we will build what's the most powerful formation to maintain a higher price, which is kind of a stair-step configuration. You go up, go sideways, maybe somewhat down a step or two, and then level off, and then back up, and then level off. And if you go up in that manner, you're building a base all the way up. So you have conviction on the buy side and the sell side, but you have conviction in the market. Whereas it just keeps going up and up. It's the last bid that makes the market. So what some people don't understand about a market, stocks, bonds, commodities, whatever, it's the last bid that shows up on the print at the end of the day. So let's, for a thought experiment, say that silver gets to $70 in the next week. And it's Friday and it's almost the close of the market and somebody bids 75. But it's for one lot, it's for one contract, and it gets accepted. Well, everyone that owns silver would look at that and say, my goodness, silver's at 75.
The stair-step pattern is the silent indicator of sustainable markets, yet most headlines focus on the peaks, not the underlying structure. Each incremental pause allows both buyers and sellers to gauge conviction, preventing artificial spikes. One contract hitting $75 may inflate perception, but the reality is thin liquidity drives such prints. Experts like David Morgan caution that markets without proper base building can collapse faster than they rise, exposing retail investors to sudden losses. Next, he unpacks why a single contract can distort the real market picture.
Well, the paper price is at 75, and there's only one contract. One contract is not substantial. Someone could come in and say, all right, I want to sell, and no one wants to buy it at 75. So the orders have to match. So the open orders at 71. And so that $4 difference gets gapped. In other words, the orders have to match. So there's a gap between the 75 and the 71. I hope I'm making sense here. But what I'm trying to point out is that in a runaway or straight up market, there's no stability. There's no foundation. There's no base. And that's why it could go down as quickly or usually quicker than it goes up. So I think I answered that sufficiently. I think we're going to be okay. I do see the end of the market like that, Elijah. It's almost inevitable because all markets get that blow off. If you look at the psychological aspect, there's a curve out there. I don't have it handy. But I look at the stealth phase, the institutional phase, the smart money phase, and it starts going parabolic, and that's the public phase. And then at the top, it says manic panic phase.
One contract at $75 versus open orders at $71 highlights a glaring liquidity illusion. In runaway markets, gaps emerge because paper positions cannot match real demand, creating volatility disproportionate to fundamentals. Historical patterns show that markets accelerate parabolically before crashing, aligning with phases David Morgan describes: stealth, institutional, public, and manic panic. Investors who ignore this risk can be trapped by sudden sell-offs, especially if their positions are small or poorly timed. Next, we explore how these psychological market phases impact portfolio stability during parabolic rallies.
And that's a pretty good illustration of the psychology behind markets. The fear of missing out that we hear about all the time. It happens to Bitcoin, it happens to real estate, it happens to tech stocks, and it will happen to silver.
It would be nice to see that kind of stair-step pattern, as you mentioned. I mean, we've seen certainly in 1980 and 2011 how it kind of just shot up so far so fast, and it did collapse after that. So if we want sort of a if we don't want that final spike in price yet, certainly the stair-step pattern would be better. I did want to ask you kind of the dynamics of what's happening in the silver market right now. I know in recent posts you've connected it to what happened when Warren Buffett was buying silver in 1999, how it shot the price up, lease rates went very high. Can you explain kind of what the dynamic of the silver market we've seen over the last couple months here?
Investor psychology is the invisible force driving silver's volatility, yet media coverage often misses the stair-step nuance. Historical spikes in 1980 and 2011 demonstrate that rapid climbs without pauses almost always end in sharp collapses. Even institutional activity, like Buffett's 1999 purchases, shows how a single player can distort lease rates and drive temporary surges. For everyday investors, Understanding these behavioral patterns is crucial to avoid emotional, poorly timed entries. Next, David Morgan examines how retail and wholesale flows are reshaping the modern silver market.
Well, the market has changed from being driven by basically the retail side. The margin of the market is what is the investment or monetary demand for silver, and then ebbs and flows. And North America is by far the largest purchasers of retail silver products. And once silver got into like the 35 range, we basically had more sells than buys. So the wholesale market, and I know a fair amount of these people on a first name basis, and I check with them usually once a week or once every other week to see what their inventory is like. But in North America, we still have we have more sells than buys. So the retail side is kind of flush with product. But what's different this time, Elijah, is that the wholesale side, the commercial bar market, is short. There really isn't enough supply or barely enough supply to meet the demand that's coming out for both industrial purposes such as photovoltaics and ETPs, the exchange traded products that are now come to the fore in India, which has caught on to the exchange traded products, and what's going on with the Shanghai Gold Exchange, where it's more of a physical market than either the LBMA or the COMEX. And there's a bigger turnover percentage-wise from what the paper contracts are versus the physical supply.
Retail silver might seem abundant, but the real pressure is in the wholesale bar market, often overlooked in mainstream analysis. North American investors hold large inventory, yet industrial and institutional demand is outpacing physical supply, especially for photovoltaics and exchange-traded products in India. Shanghai's physical market turnover exceeds the paper contracts significantly, signaling a structural shift. As David Morgan notes, paper prices can mislead, hiding real-world scarcity and potential price pressure. Next, we'll explore why Eastern exchanges could reshape global silver delivery.
And because of that, there's a high demand, and it continues. Now, whether or not it continues, indefinitely or not, remains to be determined. But basically, the last couple of months, as you mentioned, it looks as if that paradigm shift is, I don't know, but I think it's here to stay. I think you're going to see perhaps a new situation where the Eastern exchanges actually start to be more of a dominant force in the overall physical delivery mechanism than what we've seen in the past.
The rise of Eastern exchanges is quietly altering silver's global landscape, yet most reports still frame the market through Western retail and COMEX metrics. Persistent high demand and supply tightness in recent months suggest a structural shift where Shanghai and other Asian markets could dominate physical delivery. For investors, this means price signals may decouple from traditional Western paper contracts, emphasizing the need to track physical flows closely. Next, David Morgan will analyze how gold's leadership confirms broader precious metals trends in this cycle.
Well, gold has been the leader, and being a student of the markets in total, but, one that I would say taught me, maybe say the most, but certainly up there would be the late, great Jim Dines. And he had, like the Dow theory, I don't know what he called it, but basically it was a precious metals confirmation. In other words, gold could not shoot up alone without, and be in a true new bull market without confirmation from silver and really from platinum palladium. Well, that's taken place. So there's confirmation across the board that the metals move as a group in a strong bull market, and they are moving as a group. The second thing is that silver will outperform at some point. And that, of course, took some time, as we both know, but it's not unusual for silver to play catch up once this new phase of the market happens. And my magic number was 70-1 on the gold silver ratio. And I think we were at 72 or 3 yesterday. But we've certainly moved down from that over 100 we were a few months back. And so we are intact for a new bull market. I think it's up and away. Hopefully it's a base and build with some massive corrections along the way.
Gold isn't just a headline leader. It signals the health of the entire precious metals complex. Jim Dines' Dow theory-based confirmation shows that silver, platinum, and palladium must align for a legitimate bull market. Current gold-silver ratios around 72, down from over 100 a few months ago, indicate silver's potential catch-up phase, echoing historical cycles where metals rallied in sequence. Investors should watch for these base-building corrections, as they often create durable long-term entry points. Next, David Morgan will discuss how corrections in gold and silver could intersect with broader equity market dynamics.
And I'll just give you a bit of a hint from my latest newsletter, my paid service, Elijah. And I put in there that I saw perhaps that we could get below the 4,000 level in gold again, and we could get below the $50 level in silver again. And I did not get too much pushback from my readers, but I did get some. And my take on that possibility is that on the metals alone, in the dynamics that we're sitting in today, if the status quo stayed as it is, and it never does, everything changes, probably wouldn't see under 50 or under 4,000 for gold and silver respectively. However, if we were to get a large sell-off in the equity market, the S&P 500, and it was significant enough, I could definitely see the metals getting under those support levels. And that's what I think is going to happen. Now, I've been wrong for too long, but it doesn't mean I'm wrong forever. But it's a stop clock. A stop clock is correct twice a day.
Headlines may suggest metals are insulated from equities, but this perspective underscores their vulnerability to broad market sell-offs. Historically, gold and silver have retreated below key supports during S&P 500 declines, as in March 2020, when gold dipped near $450 while equities cratered. Even seasoned analysts admit uncertainty. The notion that the status quo can persist is rarely realistic. For investors, anticipating temporary dips under $50 silver or $4,000 gold highlights the importance of risk management and strategic allocation. Next, we'll assess why these dips may create a critical buying window.
But anyway, not beating myself up too much, I do think that we will see a stock market correction. The metals will go down with it temporarily. It will be a buying opportunity. But the new bulls, the people that bought at 50 plus, watch it go to 60 and are in profit zone, and then to not have a stop or whatever. I'm talking about for traders, but investors as well. I mean, if you buy it at 50, you pay a low premium. You buy a bag, and then the market's at 45 again. You get a little disheartened, especially if you're a new buyer. Again, I don't want to make a big thing about it, but I don't rule it out on those conditions. I don't see it happening again. We continue as is, but I don't think we will. I think that, you look at the high tech and the NVIDIAs, how the Dow Jones and particularly the S&P 500 are weighted so heavily to make a construct that is really not showing the true broad width and depth of the S&P 500. You take 7 of the most popular, most liquid, and most traded stocks, and you base and weight the average upon that. It's really not telling the total truth.
A surface-level rally masks the fragility of market breadth, with mega-cap tech dominating the S&P 500's performance. The concentration in 7 highly traded names distorts perceived momentum, leaving retail investors vulnerable to sudden corrections. Metals, historically counter-cyclical, often track these broad market dips, creating short-lived buying opportunities. For traders and new investors, ignoring stop-loss discipline amid inflated gains can amplify losses. Understanding the index structure is critical before reallocating capital. Next, we'll explore the timing and inevitability of broader market corrections.
So I'm just making my case again that a stock market correction, in my mind, is well overdue. And I don't think I think it is out there in the future. Not necessarily, it could keep going up, but that's how I see it.
Despite ongoing rallies, the evidence for a delayed correction is mounting, yet commentary rarely highlights overvaluation risks in concentrated indexes. Investors must recognize that not immediate doesn't mean avoided. Historical cycles show extended bull runs can precede sharp pullbacks. The market may climb further, but systemic vulnerabilities, high-tech weightings, leveraged positions, and narrow liquidity could trigger rapid reversals. For cautious portfolios, acknowledging timing uncertainty is more actionable than chasing short-term momentum.